forward here to get going.
George is right in the right spot.
Now you're good. Okay. Okay. Go ahead, Justin. I will let you start.
Okay. Well, good morning, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. As you've noticed, we've switched this around a little bit, so I'm going to cover the transportation dynamics first before Lynn steps up. So any hard questions, I get to pass them off to Lynn and head out the door. So, so with that, we'll quickly get into just an update on production. I won't get into a lot of details. I'll let Lynn cover that. But as you'll notice for North Dakota, production was up slightly. Eastern Montana, South Dakota continuing with their trends. And so again, for region-wide crude oil transportation, we're still looking at just over 1.2 million barrels per day that needs to be transported and marketed out of the U.S. Williston Basin. If we look at the production growth month over month for both crude oil and natural gas, both petroleum products were up in the month of November. Again, not to the same level we'd seen through the October numbers, but again, some healthy growth for the month of November. When we look at transportation dynamics for crude oil out of the region as a whole, again, some minor shifts taking place between primarily pipeline and trucking to Canadian pipeline systems. You'll notice on the next slide, slide 5, that green line at the bottom, we saw that trend upwards. So again, ultimately those barrels are leaving the region by pipeline. It's just whether or not that pipeline system is located in North Dakota or it's on the Canadian side of the border. I was able to double check and verify some of the numbers with some other sources, and things were aligning. And it does seem that in the month of November, we did have some high number of barrels being moved both north and south across the border. And I'll touch on that again here in just a moment. Crude by rail volumes up just slightly. Again, looking at about 150,000 or so barrels per day estimated to be leaving the region by rail car. Again, just trending upwards, keeping up with some of the growth we've seen out of the region in overall oil production. Where that oil is heading, there's been some shifts. Again, that September, October timeframe, because of some of the hurricane season issues that were impacting not only the Gulf, but as well as deliveries to the East Coast. We did see some things shuffle around a bit. So again, 3/4 of the oil continuing to move west towards the PADD 5, the Pacific Northwest area of the United States. The remaining quarter headed to the East Coast refineries in that month of October. Price dynamics, this is the first time that I can recall, at least in the recent past, that we've had PADD 5 as the highest priced market point. So again, PADD 5 being primarily for North Dakota's purposes, that Pacific Northwest region having the highest price, followed up by the East Coast PADD 1 and then the Gulf Coast down in the southern portion of the U.S. Where prices are at today, about $5.50 spread between Brent and WTI. Again, I don't see anything in the near term shuffling that around a bit, and so that does impact some of that Gulf Coast pricing. And now that we have Dakota Access in service, having that direct connection to the Gulf Coast and having that higher priced market is important for North Dakota to keep an eye on, because that does trickle back and does impact what North Dakota producers receive at the wellheads. So again, we'll keep an eye on that. LLS is a comparable type barrel down in the Gulf, and it was trading just under $5 a barrel premium to a Cushing light sweet barrel. And slide 10, this was what I was alluding to earlier with those truck volumes north and south across the border. So again, it looks like records were set in both scenarios, the amount of imports and exports. So again, these are trucks that are either bringing Canadian production down in North Dakota for marketing. They may be blended with other barrels, and the same goes for North Dakota barrels going north. They may be blended with other feedstocks and may be marketed directly. Again, there's not a lot of detail available at the public level because, again, these marketing strategies that these folks are using, they typically don't publicly disclose those, but we are able to track some of the numbers through the Federal Trade Commission and those barrels that do move north and south across the border. Moving on to natural gas, we saw a slight decrease in natural gas flaring on a percentage basis for the state of North Dakota. Both segments of the industry saw, as far as wells connected versus unconnected, both of those percentages shrunk October to November. And so this is for non-confidential wells. Lynn will have some confidential information wrapped up in his numbers, but I'm showing about 13% flaring. Again, a bulk of that coming from wells that are connected to a pipeline system. It's just, again, not enough capacity, whether it's the gathering system, compression, plant availability. For one reason or another, those molecules weren't able to make it all the way to the plant to be marketed. And as you'll see on slide 12, as I just mentioned, a decrease both in that blue portion as well as the orange, the connected versus unconnected segments. And more good news on the gas gathering challenge. Again, we were seeing in the month of November more wells getting connected to gas gathering systems than new wells producing. So that's always a good sign when the gas gathering industry is able to keep pace or get ahead and catch up on some of the previous wells that have been drilled. So more good signs on the gas gathering segment here in the month of November. NGLs, I know there's been a lot of coverage here in the last couple of weeks about natural gas liquids in North Dakota and the ONEOK announcement. So I just wanted to just quickly touch on that project. Again, the Elk Creek NGL pipeline, which is going to move primarily North Dakota NGLs south to Bushton, Kansas. Again, as you can see on the stats here, 900 miles, 20-inch pipeline system following their existing Bakken NGL as well as the Overland Pass system on its way down to Kansas. Again, initial capacity on this system, 240,000 barrels per day. If they increase horsepower and pump stations along the route, they would be able to theoretically increase that up to 400,000 barrels per day if there's a market appetite for it. And again, pending all the regulatory approvals along the route, the target is for the end of 2019 to have the system in service. And so what does that mean for North Dakota? As you'll see on slide 16, this is my NGL forecast going forward. So you can see case 1 and case 2. Case 1 in red, case 2 is the extension in the dark gray color. And what that's showing is my expectations for natural gas liquids productions from North Dakota. So anywhere between 800,000 and 1 million barrels per day ultimately as we look out into the future. As you'll notice, as we sit today, the production level is above our pipeline capacity. So we are utilizing localized truck transportation. We're utilizing rail cars in order to move all of these NGLs to market. Over the long term, again, having additional pipeline capacity is critically important because, again, natural gas liquids takeaway is one important piece of the pie in order to solve the gas capture and gas flaring challenges that North Dakota's faced. And so, again, you have to have the gathering pipeline systems, you have to have the processing in place, you also have to have the takeaway systems such as the proposed project. So as we look forward, I think this is going to add some much needed capacity to that NGL outlook as this play continues to mature. And I just included on, just for full disclosure on slide 17, how those additional barrels would be moved if there wasn't pipeline capacity. And so again, adding in the trucking capabilities, the rail capabilities. And so that is what's allowing the industry to keep pace with development at this time. And very quickly, I wanted to just touch on one more dynamic on the pricing side. We've got several slides, but what I really want to focus on, I'll just move to slide 21, Allison. This is a new map that I've just published. This is the first time it's being put out publicly for new break-even outlook for North Dakota. So what you're looking at is my estimates for break-even price ranges for the various portions of North Dakota. And so as North Dakota has moved from a lower price environment to, as we sit today, right around $64 WTI pricing, that has shifted economic regions of the state. And so that's what I was trying to capture with this analysis. And what you'll see on slide 23, I think, is the most important part of this. As we've moved from the 2017 average into just this first portion of 2018, we're looking at roughly 44% more acreage in the Bakken that is now could be considered economically attractive to producers to develop. Again, in one of the previous slides, I noted very importantly, just because it's economic doesn't mean it's the most economic for individual producers. So again, we'll likely continue to see activity focused in the prime portions of the state where they're able to receive the highest well productivity, but we shouldn't be surprised and we should expect to see those rigs start to move outward into some of what we would have considered the fringe area a year ago are now considered to be economic territory within the state of North Dakota. So again, as the prices fluctuate and as prices have risen, we can expect to see that rigs and activity and completions will start to move outside of where everything's been focused the last couple of years here. And so with that, I'd be glad to answer any questions on the economics, the NGL dynamics, or anything else covered this morning.
Okay, question, go ahead.
First off, when you talked about the trucking from Canada and then back into Canada, did the Keystone spill and potential the shutdown of Keystone for a while, would that affect that?
No. So the question for the audience was Keystone, the pipeline system, would that have any impact on the U.S. Williston Basin truck imports, exports? I don't think so, because the Keystone pipeline, the original Keystone, moves Alberta crude oil, not necessarily the U.S. Williston Basin crude. So two separate dynamics at play. So I don't think that played any part in it.
Along those same lines, any thoughts on why then the increase?
I don't have a lot of color. Again, I just received these numbers here in the last day or two, so I don't have any real background information for folks. And even when I do have more time to look into it, it's typically very difficult to find information because, again, it's marketing decisions by the industry participants of where they want to market their crude. If there's an advantage to a certain crude grade at a certain time because of shortages or surpluses, again, the industry will work and either do some blending or trucking to different destinations. So, and it's very competitive between those marketing agencies. So that, again, very little information is typically available on really why that takes place.
Can you elaborate about the break-evens? Is it that things are becoming cheaper and therefore more economic, or is it more because of the price is increased?
Yep. So a couple of things. And so what's impacting this move outward? And so the first thing is pricing. And so you're able to, let me move to just slide 22 for a moment. And what you're looking at the top portion of this pie chart, that's well productivity. And so you'll notice at the bottom is break-even prices. So if we just pick the 500 barrel a day wells, it takes between $49 and $61 to make that economic. Well, a year ago, when prices were, say, at $40, you couldn't drill a 500 barrel a day well and make it economic. You would need to have a higher performing well. And so now as prices have risen, they're able to move to the portions of the play that aren't capable of these high producing wells, but they can still produce good wells that at the right price point become economic. And so as prices have risen, as technology has improved, they've been able to take areas where maybe the break even 3 years ago was $60, and they've been able to take new technology. Now they can make it $50 work in certain areas. So again, it just depends upon technology and price point for where they're able to make the stock and production work.
Okay, could you elaborate more on wells connected to gas gathering systems than there were new producing wells? Do you have any numbers on that? How many more and how many are still unconnected to gas gathering systems?
I do have all of those numbers. All I have right now is a chart. I don't have the hard numbers behind it. I can certainly get that to anyone that asks for it. Again, what we're looking at on the chart, new wells selling gas, that's the black line. So those are wells getting connected to gas gathering, and the red line is new wells producing natural gas in the state. So again, we'd like to see that red line below the black line.
Now, on the NGL pipelines, we quoted Public Service Commissioner Julie Fedorchak saying she's liking that the ONEOK line that's being planned for eastern Montana. But she did raise a concern about having enough NGLs available in North Dakota in case petrochemical industry gets started here, and that's been a goal of the Commerce Department. So just your thoughts. Will there be enough NGLs for a petrochemical industry in North Dakota?
As we look forward to North Dakota's petroleum development, again, I believe that there are enough natural gas liquids to not only be utilized in state, to connect to markets outside of the state. Again, as these pipeline systems develop and connectivity increases, markets start to open up. And so I think that even having additional pipeline connections to other producing regions, to other supply regions, I think that is just going to overall be a benefit for the industry as a whole.
Okay. With your break even, what years are you covering?
So the wells that I used to create that were all 2008 wells and beyond. And so you can see the economic assumptions on slide 24. So you'll notice a range of those break-even prices, and why there is a range is because I use $6, $7, and $8 million wells. So again, the lower number correlates with the lower well cost. So again, if an operator has higher well completion costs, then they'll likely have the higher of that range if they're able to, because they're drilling shallower or they're not using as much proppant or water, maybe closer to that $6 to $7 million range. So again, that's why you see the range, and there is some overlap again, just because of the way the numbers work out.
Okay, Justin has to get to another event, so we will let him go. Looks like the questions are pretty much concluded anyway. So thank you, Justin.
Thank you. I'll take that with me.
That would have been very interesting. Check out the next meeting. I'm supposed to put it on?
Yeah,
Really?
yeah.
Okay.
If you need that data, Allison, just let me know.
Okay, I will.
How we doing?
Trying to get everything. Okay. All right. Go ahead, Mr. Helms.
Hey, well, thanks everyone for coming to the January webinar. We were talking 2 months ago, so we're talking November production. That's just a normal lag. Hopefully you got the correction. I apologize for the last 3 digits of the daily oil being wrong, but I think Allison sent out a correction. Not a big change, but probably the most optimistic outlook we've had in a year or so. Oil production up again 1%, almost 195,000 barrels a day. So we're closing in on that 1.2 million a day number. Pretty important number since our record production was 1.23 million a day, and that was way back in December of 14. So we're closing in on 4 years since we set that record. Everything looks like sometime in the first half of this year, we should break that record and start setting record production again. And I think you probably have been seeing the articles in the national media about U.S. production. We're not the only people setting records. New Mexico is setting records. They've now moved into 3rd place in the U.S. in production. They're a long ways from North Dakota, but it is sort of interesting to see now Texas, North Dakota, then New Mexico, followed by California and Alaska. So the shale oil producers truly are the producers in the United States. And I think the EIA is thinking U.S. production could reach 10.3 million a day by the end of this year. So that brings a lot of attention from the people who've been restricting production in order to balance the world markets. OPEC recently came out, in fact, just this morning, and said they plan to stick with their production cuts and allocations through the end of this year. They think that at that point in time, The markets will be able to manage it on their own. Russia, on the other hand, who agreed with OPEC that they would restrict production 300,000 barrels a day, is beginning to get cold feet. And so next week they're planning to meet with OPEC and seriously start talking exit strategies on how to begin backing out of the production cuts. At today's Brent prices, the production cuts start to look like they don't make a lot of sense, and that the market may be in balance or very near in balance. So it'll be interesting to see. While I'm talking about that, of course, price is up significantly, up over $5 a barrel from December to today. And so that's pretty substantial. Industry is looking at that, and the current conversations with industry are talking about adding 5 to 10 rigs in the second and third quarter of next year. That, of course, is going to depend on workforce and infrastructure. Justin and I are going to be talking to the Petroleum Council members a week from Friday about where infrastructure dollars need to go in order to make this happen. I think he had a great analogy. I was talking with him last week, and he said he got the sense that industry wanted to take off running, but their shoelaces are tied together, and so they're barely able to walk in terms of increasing activity because we're up against gas processing and gathering infrastructure. We've maxed out produced water gathering infrastructure, and as you saw from the rail increase that Justin showed, we're pressing the oil pipeline export infrastructure as well as the natural gas liquids. So when you look at that, and that kind of turns us to the gas picture, up 1.4% natural gas production, new record in terms of natural gas production and NGL production. And that is going to have to be processed and moved to market. So there's going to be a lot of strain on the gas capture requirements that the Industrial Commission has in place. When you look at Justin's break-even analysis and spend a little more time with that, you're going to see that the big winners, as we talk about the 5 to 10 rigs being added, looks like Burke County, Divide County, and Williams County are where those rigs are likely to go based on the better oil prices and the break-even analysis. So that's got to be exciting to those places because Divide County has been sitting at 0 rigs for some months now. Burke County, once in a while a rig. It is interesting to note that those break-even numbers that he was talking about in those counties are about equivalent to what people are getting in the Permian. So there's going to be competition for that drilling activity and those drilling dollars to go to Texas and New Mexico instead of come to Burke, Divide, and Williams County. So we'll see how that plays out. I think on the optimistic side of that, the companies who used to own those properties and would normally be deploying those rigs have actually sold those assets to smaller companies like Kraken and Liberty Resources. And so the Oasis and Continental Resource folks that used to own those assets in Burke and Divide and northern Williams County, where there would be direct competition with the Anadarko and the Permian, they don't own them anymore. And so these small, mostly pure Bakken play companies that are really invested in the Bakken are going to be the ones taking advantage of that. That's why we're so optimistic about the 5 to 10 rig increase. So I know a lot to evaluate. One of the frustrating numbers for us is the inactive well count. It was actually up 21. Better oil prices, we really thought that we would start to see inactive well counts turn and go down, but companies are deploying their dollars to drill and frack. They are not deploying their dollars to return inactive wells to production. And so we may have entered, as I started to indicate last month, and we'll know better a couple of months out here, but we may have indicated this or entered this new normal where 850 to 900 non-completed wells and 1,500 inactive wells is the norm. That is not the kind of numbers that a regulator likes to see. And so, you know, we already started having discussions. We had all the field staff in last week for training and meetings and discussions. And one of the big concerns on the part of the field inspectors is inactive wells. And what can we do policy-wise? What do we need to be doing in order to minimize that number? Because those are the ones that present a risk to the state in terms of the wells never being reactivated and ending up as a liability on a bond or against the state's abandoned well plugging. And I reassured them, we're not the only state struggling with this. Almost every state that I have met with at IOGCC is struggling with the same problem. Some of the Canadian provinces have it tenfold what we're dealing with. And so it is a hot topic in our legal and regulatory committee and also in the international committee. What can states and provinces do about inactive wells? How do we reduce that number? How do we get companies to take care of that liability? What do we do when companies want to transfer those assets? What do we do to get them reactivated? And so we'll stay tuned. We're all thinking collectively as to how to deal with that problem, but it is a frustration. As we turn to gas capture, it's really good news. We got back above the 85%. We're not at the 88%, but if you look at non-Fort Berthold Bakken, we're at 90% gas capture. The good is the statewide 86% of all gas, 87% of Bakken, 90% off Fort Berthold. The bad is Fort Berthold is really lagging at 75%, and trust lands on Fort Berthold, they're only capturing 72%. Somehow, we have got to get the Department of Interior's attention and get this problem fixed. It is a problem with pipeline right-of-ways. It is a problem with not being able to get air permits to build compression facilities on the reservation. It's just a problem all around within the federal government. And I know they're extremely busy. You know, they've been dealing with the waste prevention rule and lawsuits in California. They've been dealing with the hydraulic fracturing rule, but we have got to get Secretary Zinke's attention on how can we get gas capture on Indian lands improved, because it's really under their control. The last thing is the litigation at the BLM level is like the Energizer Bunny, I'm sorry. It just keeps on going and going and going. And every time that we see a breakthrough in one court venue, we take a step backwards in another. So the hydraulic fracturing case and rules was that case is essentially over in Wyoming, although Friday there was a new motion filed by the Ute tribe to revitalize the Wyoming litigation of the hydraulic fracturing rule. And now the rule to rescind the hydraulic fracturing rule has been published, and a lawsuit's been filed in California to counteract that. And on the waste prevention or venting and flaring rule, the 10th Circuit is still dealing with that in the Wyoming courts, and there's litigation in California. So it just keeps going around in circles. It is like the Energizer Bunny. But we're pretty optimistic. Everything points to more rigs, more frac crews, more activity in North Dakota, especially in Burke and Divide and Williams County as we get into the latter part of the first half of this year. There is some interesting information out there. There were a lot of electrical power problems in McKenzie County the last week of December and all the way through this first 2 weeks of January with the extreme cold weather. We could see production dip when we get to the January numbers, which we won't be talking about until March, but we could actually see a little bit of a hiccup in terms of oil and natural gas production as a result of that. So it's amazing how tied together all these infrastructure and workforce issues are. So just a little warning sign on the horizon that January numbers could take a step backwards. Shouldn't be any surprise to those of you who've been taking part in 20 to 30 below and the wind chills that we've been having, but that normally reduces oil field activity. So that's our report for November production. A lot of optimism, great numbers, almost everything up. We'll take questions.
Can you
Amy.
refresh my memory on the inactive wells? How long can a well be on inactive status?
Yeah, so the question was on inactive wells, how long can a well be inactive? And it can be inactive for 1 year based on North Dakota rules. That's one of the rules we're obviously looking at is that a good idea? That came about because of our weather cycle. You know, we really hesitate to have a well go inactive and then hit abandoned status and begin to be a rule violation in January when there's a lot of snow and cold weather, and you really don't want to force companies to deploy a workover rig crew when it's 20 below. So, but in North Dakota, it's 1 year on inactive status. At that point, it hits abandoned status, and 6 months later, there's a plugging requirement or post a full plugging bond, and then 6 months later, it's absolutely plugged the well. So really, once it goes on inactive status, it could linger there for 2 years, and I think that's why we're seeing that number grow. So that's one of the rules we'll be taking a look at is in today's world with today's technology, should it be a year or should it be something different?
Did you extend those during when the prices were low?
Yeah, the second question was, could we extend those when the prices were low? And that policy is actually still in place, and the Industrial Commission will be looking at that, not this month, but in February or March. We did allow for inactive waiver extensions for wells to remain on inactive status when oil prices were low, but they're well above those price points now. And I expect that inactive waiver policy to go away. That's going to be my recommendation. At these prices, you can't justify it.
Okay, trying to decipher this question. I'm thinking this person is asking, come November of this year, because that's the next time we change goals for gas capture. Do you think industry is on track to hit those, or are we looking at needing to impose penalties or production restrictions?
Okay, there are two pretty significant natural gas plants and expansion projects that should come online if they are on time. If we see the 200 million a day plant in not Garden Creek but Wild Basin come on, and we see the expansion for the coming off of Fort Berthold. I always forget whether it's Arrow or Targa or which one of those it is, but is it Targa?
I think it's Target.
Okay, well, it's not.
Oh.
It's Arrow. Okay. See, I always get that mixed up. I should make a note, and I apologize for that. But if those two are on time, industry should be able to just make it. But I mean, that is an if and a just make it. Now, if you add 10 rigs to the rig count, and the completion crews, the roughly 6 completion crews that will take to keep up with them come along, or people really begin to activate non-completed wells, they're not going to make it. It's going to be that close. And that's really going to be the heart-to-heart conversation that Justin and I plan to have with the operators the end of next week is the way things look right now, you are barely going to make it. And if you increase activity, drilling and completions, you will not be able to make the 88% capture number. So we've got to have some serious investment in gathering and processing.
Okay, do you think Permian growth is affecting Bakken growth? And then second part to that question is, if North Dakota production continues to grow, where do you see it peaking?
Okay, so the question is absolutely. Two significant operators, WPX and Oasis, are now spending the majority of their capital in the Permian, and they both were major Bakken players. Oasis, in fact, was a pure Bakken player, and they just invested $946 million, I think it was, in Permian acreage. So that clearly is impacting North Dakota Bakken activity. Now, we still think production is going to grow. Like I said, the assets in Burke and Divide Williams County, where we're going to see, we think, rigs deployed and increased activity, those have shifted to some smaller players, and those players are capitalized and they're ready to expand. So we're going to see increased production. You know, visiting with Justin, he and I work together on the production estimates. We still see production getting to north of 1.8 million barrels a day, maybe achieving the 2 million barrels a day. It's all going to be price dependent, and you know, the slower it grows, the less chance there is it'll hit that 2 million a day mark. But these kind of oil prices, given you know, if we can reduce some of the constraints, then we should be able to punch through that 1.8 million a day and get close to 2 million. So yeah, we're back into growth mode. I can't promise that between now and mid-year it's going to be growth every single month, because like I said, we just saw this information today that we had the power outages or power problems in McKenzie County in January. So you know, any given month we could take a step backwards, but we are definitely back into growth mode at these oil prices. A couple of our other infrastructure concerns, by the mid-2020s, the Northern Border Pipeline will be moving 100% North Dakota gas from Watford City to its terminus. So that means that by the mid-2020s, we've got to find another natural gas outlet or expand that or do something with it. And likewise, by the mid-2020s, DAPL will be full, maybe by the early 2020s. And so we're going to have to be looking at another significant crude oil pipeline if we want to maintain the kind of pricing that we're seeing.
Do you have any other details that you can provide on the McKenzie County power outage?
I don't. You know, it's pretty new information, and what we know is that there were multiple compressor stations impacted and all of the producing wells around them. So the gas plants were fine. They have their own backup power, but the compressor stations were not. And so the gas plants were starving for gas because the compressor stations were down, and the very same power systems feed all the producing wells around them. So there was quite a bit of production that was down, and for, well, the better part of 2 weeks now.
Are we seeing any pricing on service companies like rigs and frac crews going up or down? Is that going to impact the ability to bring on rigs and frac crews?
So what we've seen, and I'll I guess throw a caveat on this. The first week of February, I get to meet with the CEOs of some of those companies in Houston. So I'll have more information then, stay tuned. But we have seen price discounts begin to go away in the contracts. And so the service providers are beginning to increase some of their pricing, and I think that's helping them to hire and train crews. So again, though, the frac crew workforce is going to be really a potential limiting factor as to whether they can get qualified people to work on frac crews.
Do you have a time frame for the 1.8 to 2 million?
Not off the top of my head. I think it's in the late 2020s. I can get back to you on that, but I think it's 10 years out. That's based on our, best estimate projection. But the trend, the most recent trend, has been much steeper than the projected lines, and so that would be at the latest 10 years.
It's been about a year since we had a new president. Have you guys seen any direct impact from the new administration on the oil industry?
Yeah, so the question was any direct impact on the oil and gas industry from the new administration. Probably the two biggest ones is DAPL. The Dakota Access Pipeline completely changed the world for North Dakota operators. Most North Dakota operators are now getting WTI, or in some cases a premium to WTI. And so it shifted economic interests back towards North Dakota in terms of oil prices. It made us highly competitive with the Eagle Ford and Permian again. The second was the tax reform. The big reduction in corporate taxes and income taxes has really pumped up the bottom line for a lot of our large independent oil producers. When you look at some of the other regulatory reform, that's been a lot slower and harder. And like I said, so much of that has gotten tied up in this litigation merry-go-round that we haven't really seen the impacts of that yet. But two major impacts. A lot more money on their bottom line from the tax reform, and the DAPL thing, a lot more money on the front end on the value of oil.
Do you know the volume of gas flared, and do you know how many operators did not meet the target?
I don't know the number of operators. We talked about that this morning, Allison. We'll get back to you on that. The volume of gas flared was 282 million. It was down 65 million from the previous month, but 282 million a day. Which is enough for almost 3 conventional gas plants. That sort of the standard size of a off-the-shelf gas plant is 100 million a day. So there is obviously investment opportunity here, and I think it's encouraging that now with better natural gas liquid pricing, it's actually profitable to gather and process natural gas again. That wasn't the case for most of all of 2016 and a good part of 2017. It was not profitable to gather and process natural gas. But with a little bit better natural gas pricing and much better natural gas liquids pricing, it's now profitable. So there's a good reason to go build those 3 plants.
Last question here. All this good news, is North Dakota headed for a second boom or second wind?
I'd probably categorize it more as a second wind. I don't think anything. We don't envision anything that would compare with what happened here in 2011, 12, and 13. But this is going to be a really nice bump, and it's great to hear and feel the optimism and see companies really wanting to invest their money in North Dakota and put people in North Dakota. So yeah, we're going to get our second win.
Okay. Thanks, everyone.